Hi there, I'm Dave Keller here with StockCharts.com and welcome to Behind the Charts. We sat down not too long ago with Todd Gordon. He's the founder of Trading Analysis. We met up with him at the Las Vegas Traders Expo. I think of Todd as an educator. He does a lot of speaking during the day, sort of over the shoulder from his trading room. And so he shares a lot of what he's seeing and what he's hearing with people real time during the day. We talked about mental states and how to approach the market from a mental way of thinking, right? How you think about how you think, which was actually pretty interesting. And a lot of times, the decisions you make as an investor start with the way that things are wired inside your head. What I most enjoyed about my conversation with Todd was talking about his mentors, and we particularly talked about John Murphy, talked about how that book on Intermarket Analysis that many of us have read and learned from was seminal for him, was really important, pivotal for helping him understand intermarket relationship, thinking about how equity is related to other asset classes. I also especially like Todd's comment about lessons learned. I love asking people a tough experience, what's a loss or a tough period that they learned from. I thought Todd's answer was incredibly illuminating. So here's my conversation with Todd Gordon of Trading Analysis. Hey guys, here at the Las Vegas Traders Expo, sitting down with Todd Gordon. He's the founder of Trading Analysis based in Saratoga, New York, Saratoga Springs.
That's
what a cool part of New York.
Thank you.
But good to sit down with you. Thanks so much for giving us some time.
Thanks for having me.
Yeah, it's a pleasure.
I really enjoy the show, what you guys are doing with the Final Bar.
Thank you.
It looks first class. Well done.
Feel free to expound on that anytime during the next 20 minutes. That's perfect.
Let's talk about it. Have you seen the show?
Let's dig deeper into that. No,
you guys are doing a nice job.
Thank you so much, and we'll upgrade our talent having you on the show as a guest. Thank you so much for coming on. So your firm Trading Analysis, we were talking before we started just about, trading, applying technical analysis, applying charts, but doing it in a transparent way.
Yeah.
How do you feel that helps individuals learn the practice better? Because I find that's the toughest thing when people get started, is just trying to take that leap and have the comfort to actually take positions and ride through them. How do you think about that transparency? How do you try to approach education for them?
I think the integrity of our business is very important, and I think through what your company's doing and several other companies, the integrity is increasing. And this is the one. And sorry to start off this first interview with a little bit of a complaint, but the one complaint I would have to our industry is the barrier to entry is so low. It really doesn't require much of a certification. You have a screen capture software, some charting, and you're in business.
You're done.
So what I really like, especially what your company's doing and several companies coming together and raising the bar in terms of you need to be sort of in a network to be in the so-called experts. So one. It's kind of like an SRO. We're kind of regulating each other, which I like. So integrity is important. It's the only way I was going to run my business. I've been doing it now. Really, I traded right out of college. I was a prop trader. Went to a little CTA. Went out on my own. I was in 08, actually 09. I left after the credit crisis. I was trading for a hedge fund, also writing a research report on Wall Street. And basically, what I would do is I would write a daily research report, go execute, and with one trade idea, entry, stop, and go execute the trade in the hedge fund. And I'd come back and I'd report, we made money, we lost money, here's the whole process. It would drive my compliance department insane.
They love that kind of thing.
It drove them nuts. So when I told them I kind of wanted to go out on my own, I built the reputation of owning the losses, also having winners, right? And being transparent. It's the only way I wanted to do it. And I think I built a following back in 09. I launched myself in 10. Here we are 19. So integrity is important because I have a problem with the low barrier to entry. There's a lot of competition that we have out there. So I don't put a trade alert out for my business unless it's based in solid fundamentals, technicals, and then I have the trade on myself.
Got it.
And that's just the only way I want to run my business. So it's important to me.
That's good, and I like the fact it's a very genuine approach, right? You're sort of you're doing what you're saying as well, which is kind of it's pretty refreshing actually. Right? So you'd mentioned a loss and how you own your losses, and I would say, again, working with people that are getting started trying to trade, invest their own money, it's one of the toughest things to do. How have you learned to deal with periods of loss, or when things start to not work and you have to deal? I mean, how do you mentally deal with that behaviorally? What do you do?
I don't know yet. and if I'd love to know what you think, Dave. There's times where you're out of sync with the market. The market's out of sync with itself. The market's just not trading well. You could be firing, you could be on point, you could be rested, you could be, there's times when you're tired or distracted and you're not, you're trading emotionally and you're out of sync, or the market's out of sync, or a combination of the two. So then comes in the question, can you trade out of a drawdown?
Right.
I still don't know the answer to that. You've got to decide if you are out of sync and you got to get yourself right. You got to be working out, you got to be healthy, you got to be rested, or is the market the issue and you just have to say, all right, shrink. And this is what I did over the last 3 months. Shrunk the position size, feel good. We were in Saratoga, we were having some fun. Saratoga's fun in the summer, but not too much fun. I was like, this market is just so nonsensical. I just don't like the way it's trading. So cut the position size down. And just over the last month, I've really started to get after it. I'm pretty leveraged with some NDX call options on the upside. I have more allocation. I just feel like the market is finally trading. So you got to figure out, is it you or is it the market? And I think that's why you need a group or a person, somebody who has experience, because you can only make that realization through screen time and going through repetitions. And I can honestly say to my subscribers, like, guys, I think the market just is not good right now. And I'm completely content just scaling back and being quiet. And people pay me monthly and I say, look, I used to feel very bad about charging someone $100, $200 a month to say do nothing. But how many of these guys who are just a couple years into the business can blow themselves up in a dangerous market?
That's right.
And you've got to learn to sit on your hands. So I answered that in like 3 different ways. I don't know what the answer is to that. What do you think?
Well, it's funny. I've spent a lot of time coaching professional analysts, institutional analysts, and what always struck me is these, in general, the average analyst was really accomplished academically. They're used to being right a lot, and they're used to good work and thorough work leading to good results. And we're in an industry where your process might be impeccable, but just the market goes against you. It's just not the time. And so I think that ability to recognize when even your best effort it's not the right time for it. Recognizing that and admitting when you're wrong is probably one of the things that's most difficult to do, but probably most helpful to your portfolio. Admitting that you're wrong at something, admitting it's not the right time.
And most of our viewers, and tell me if I'm wrong, are not going to their job responsibility doesn't end with being an analyst, right? Because analysts, you always have to have an opinion. When I go on TV, I have to have an opinion. I can't say, well, if A happens, we'll do B. If C happens, we'll do D. And they won't book me again.
That's right.
The viewers at home, they've got to take the analysis, either they do themselves or that they get from us, and then they got to put it into action.
That's right.
Right? So you got to wear 2 different hats, being an analyst and plus an analyst and a trader, because they're 2 pretty different.
Very much in terms of skill sets and all of that. So you had mentioned the importance of people learning from you, sort of you putting things on and having that be such a great way for people to learn. Who were those people for you when you were getting started trying to learn how you're doing? Who were those mentors or people that you read or that you were able to learn from that helped shape how you approach the markets today?
Oh man, this is a long. All right. First, 14 or 15, my mom gave me some money to allocate towards the mutual funds. Hooked. Opened an E-Trade account when I was 17. I think I forged my account. I was supposed to be 18. I was 17. I took my money that I made at the Glens Falls Country Club.
Nice.
Was day trading in 1998 on AOL dial-up, trying to day trade. This one guy, I think he's in jail. I don't know. Maybe he's not in jail. Hopefully he's not. His name was Tokyo Joe. He was like this short-term day trader, and I got hooked. Blew up my account, lost my $4,000. Had like a $300 AOL dial-up phone bill because it was long distance. My mom showed me the phone bill. I was home for she's like, Todd, what are you doing?
Well done, right?
Got hooked. Like, this isn't going to work. Traded through college, put more money, read Alexander Elder's first book, Trading for a Living, learned trend lines. Traded through college. My first job was prop trading in San Diego with a guy named Dave Floyd, who I'm still friends with today, forever. Prop traded for a while. Went up to a little CTA and publishing company in LA. Rolled that into Wall Street for a foreign exchange when FX was going crazy in the yen carry unwind, credit crisis.
Sure.
And that I kind of, sorry, I forgot the question. Where was I going? So early was that. The biggest transition, I guess, where I'm here able to speak to you to now is I'm a huge fan of Elliott Wave, and I love it.
Got it.
I hate teaching it. I hate teaching it. I work closely with Elliott Wave International. Bob Prechter is a friend.
Yeah.
He's from upstate New York, and if you know that,
That's right.
he guided, tutor, in several pretty historic market events. So basically what I was doing is I had to write a daily research report. If I can tell you a little story.
Please.
This was working for GainCapitalForex.com 2004 to 2008 in the city. And I had to write the daily research report to get out to customers around the world. You can't write like when MACD crosses or when it gets up the Bollinger Band, put the trade on. So you got to find a way to get ahead of the market and anticipate the trade. And we were getting all the research reports from all the major investment banks like UBS and Deutsche and Barclays and Merrill. And there was technical analysts and they would send it to us. And the guys who were doing Elliott and Fib were able to say at this price point in the future, should the market get there, then execute the trade. And I was like, this is the way I can do it because I can't, how do you see a trade 2 days ahead of time and write the research report? It's like, this is the way I can do it. And I just quickly fell in love. I eliminated all the superfluous money-losing trades that weren't planned out. I put the one trade on that was based on Elliott and Fib. And because you could say, I'm a seller here, stop loss here, first take profit here. You could do 3/4 of the trade before $1 goes in. And that's what kind of launched my career. Again, Elliott's my first love. I'll do it forever. I hate teaching it because most people are just like, they want to be told that A plus B equals C, and this is your formula to making money, where
it's a little bit of nuance in there,
future's
probably,
not written.
That's right.
It's the future's not written. You've got to have EQ, emotional intelligence, to know you can't control the future. You can only control the now.
So you talk about Elliott and Elliott Wave, Fibonacci, and I know from following some of your work, Fibonacci is something that I've recognized has come up a lot. How would you describe your technical approach, or if I gave you one chart to look at a currency, a pair, or something like that? What would it look like? How do you approach something if you're looking for the first time?
Sure. So the thing that really pulled it together for me was I've only met him once or twice. I guess he's your boss. Is he your boss? Is he your friend, John Murphy?
Mentor. How I would describe it to many of us, right, in the industry.
That Intermarket Analysis book, Profiting from Global Macro Relationships, I think it was the blue book. I read that, and that was just like, that was the second, like, holy cow, book.
Wake up moment.
It was first I read Prechter's book, the 1979 book, which was harder than most calculus textbooks in college. Then I read Intermarket Analysis by Murphy, and I was like, this is what's missing for me. Because you can have, I call it single chart analysis, whatever your style, whatever your sausage grinder is on the technicals, like fine, you better be right, but add another dimension to it. Look at what FX pair is correlated to, interest rate spreads or commodities, or during the 07-08 crisis, the yen carry unwind and the S&P futures were lockstep. It was unbelievable. Watch the relationships, and that gives your single chart technicals another dimension. For me, that pulled Elliott together because there are multiple scenarios that how the future can unfold. Like, I'm smart enough to know I'm not smart enough to predict the future. There's multiple ways that the future can unfold. And if you just look at what correlations are happening with your market in question, you can reduce some of the subjectivity. So I love looking at correlations. And people say to me, it drives me nuts, David, I'm sure you hear this, they say, oh, well, they change and they don't work anymore. Well, fine, use them until they don't work and then go on to the next one, dude.
It's funny, you mentioned John Murphy's work, and I think one of the things I got out of it is sort of what you're alluding to. It's so easy as a chart watcher, as a chart analyst, to get caught up into this specific chart in a vacuum. It's like, here's what I'm seeing. But what I learned from John's work is that it's not in a vacuum. They're all interrelated in different ways. So thinking how this relates to all these other things is important. So along those lines, can you talk a little bit more maybe about your routine? Do you have a normal daily or weekly or monthly process, some way that you try to understand what's going on around you and make sense of the world visually?
I'm not a process-oriented guy. I mean, I'm more of a field-based trader. I don't have a 10-step checklist that I go through. I mean, when I sit down, I always look at the macro flow. I mean, Intermarket Analysis has made a forever change, lasting impression on me. I always want to see what fixed income, commodities, currencies, and equities are doing, watching how they're flowing. Are we on risk? Are we risk on? Are we risk off? Is risk on entailing higher bonds, lower yields, or higher yields, lower bonds? How does commodities come into play? I want to see what the flow is. I want to see what the dynamic is, right? And then I always take the index, I always take that macro flow, and then I primarily trade U.S. stock index and equity options and also stocks in my portfolio. Then I drill down and say, okay, are we in a risk-on scenario being confirmed by fixed income, commodities, what currencies, whatever? I can't wait for currencies to move again. Like, it's going to be amazing. Like, I think they're going to be delisted soon.
Right. At some point, right?
So I just look at the flow, and then I'll go down, and then I really am starting to use, I really like the sector rotation out of RRG. I'm starting to use that now. So I want to see where the rotation is. I want to see what sectors, and so much of the presentation I just gave was really based on interest rates, and the rotation we're seeing is based on yields and based on yield curve, and you're seeing a move into financials. Financials have been so oversold, just starting to break out. I haven't even taken out the 2008 high.
That's right.
Financials coming in, industrials coming in, materials coming on, and we're seeing just huge broad-based rallies with strong breadth and strong volume on the advancers, where the large cap tech and some of the large cap financials have just started to break out. So you're now starting to see the indexes go. So from that macro flow, look at the sectors. Do I just want to trade the ETF or do an option overlay on the ETF? Or is there individual stocks I want to put in my portfolio, or do a shorter term option trade and try to generate some alpha?
Yeah. So you mentioned a little bit about just the environment we're in right now, right? I mean, the equity market's continuing to go to new highs. Small caps, mid caps that have been lagging a little bit, also starting to break out a little bit. You mentioned the financial sector breaking out of some huge bases on some of the bigger banks. What are you seeing in the equity markets going into year end, into next year? How are you thinking about it overall?
I'm long. I have a pretty good NDX called Butterfly. I get kind of into the weeds with some option plays. I put it on 3-4 weeks ago. Been very vocal about it. It was at 81.50, 82.50, 83.25 called Butterfly when the NDX was trading like 78, 7,900. So it was a pretty good way out of the money. That's been my main option position. I'm about 98%, 95% long in my stock portfolio. We're seeing technology's already made the move. XLK is already starting to come off a little bit. I was thinking communications would go. Facebook isn't really doing it. Google's going, but it's not really breaking out. Twitter didn't help the XLC at all. Holy cow on Twitter. So I was thinking communications would go. They didn't go. But now we're starting to see rotation in materials, industrials, and financials, right? Which we're seeing just such a broad-based rally right now. So I think we just have to have a pretty wide allocation to everything. I don't think you need to be so long tech right now. Apple's had such an amazing move. I'm just so afraid we're going to go through this routine again, where we're going to get interest rate sensitive sectors starting to move up, pushing interest rates higher. We get scared again and go through this whole routine. Like we just went through like another taper tantrum, right? Right? When was the last mortgage taper? It was like 5 or 6 years ago.
Yeah, that's about right.
And then we just did it again. So we're just in this vicious cycle. So I'm hesitant. I like these different sectors moving. But we obviously can't let interest rates get too high. And plus, we've been in a 38-year downtrend in yields, on the 30-year. So let's not say, oh, this is the low. I think we're good. I think the Fed is out of the way. I don't think we're going to see interest rates skyrocket right now. I think things are settling down. We could go back into this low volatility kind of grind higher. I don't know what sectors are going to push us higher. I kind of want to have exposure to everything in here. There's a possibility. I mean, this Barron. I just talked about this Barron's big money manager poll. Did you see this? 27% of wealth managers in 19 are bullish the market. And we're like 3% off the all-time high. Saying, what? And they said the bearish reading was the highest in 20 years.
Isn't that wild?
Like, what? I said this on CNBC. Like, what are you talking about?
Fairly unloved, right?
Like, how do you sit here with stocks at all-time high and say recession's imminent? Like, if you see a train on the tracks coming at you, get out of the way. Like, everyone's going to sit there and just get run over by this.
It's so funny how often people forget that one of the best leading indicators for the economy is the stock market. So when the market's going up, it's hard to think that that's coming fairly soon. So you seem pretty constructive, overall pretty bullish on equities. I love to think, what would tell you maybe that's incorrect? Is there a certain breakdown or reversal or inflection point, a sector that might start to falter, what would tell you maybe to rethink that a little bit?
So I'd have to really get into the Elliott wave weeds with this.
Yeah.
The 2009 price structure of the S&P, it really doesn't fit the mold of an emotive, impulsive rally.
Yeah.
It really looks corrective.
Right.
So I am long, like I am the most long I've been. I just put more money in my portfolio but I am very aware if 30 it's a fib extension based on a possible B wave to get a little bit it's 3152.
Okay.
That's the 1272 extension of I think the September high to the December low. What was the high in 18? August, September down into December.
Yeah.
If you do the 1272 of that, I think it's 3152 on a semi-log scale.
Okay.
And that's 1272 is the square root of 1.618,
right?
Where 786 is the square root of 0.618.
Yep.
Those guys, if you go 786, retrace me, you have a pretty good shot of going 1272.
Okay.
I've seen a lot of false breakouts of that 1272.
Interesting.
If we failed 3152 in the SPX, that price structure that was, because 2019, like we talked about earlier, was such a lousy trading environment until just recently.
Yes.
It was trading like a correction. And it might not be impulsive. And then people are going to say, oh, Elliott wave is no good because I can't tell you exactly what the future is going to hold. Right. Dude.
Right?
So if that happens, then I'm like, maybe that was a B wave and maybe we do have C down.
Okay.
That's where I'm going to say I'm wrong.
It's a great level. Okay. I'd love to ask people, and I phrase it different ways, but it's basically the worst trade question. What was the worst trade, or best learning experience? When was a time when something completely went against you? What did you learn from it? How did you kind of get through that period?
Bonds, actually, you know what? I've got two bad trades.
Okay. Good.
I think it was 08 or 09. Euro. It was during the credit crisis. Euro was getting crushed. Euro dollar was selling off, euro yen was selling off with the yen carry unwind.
Yep.
And I think it was like 08 or 09. Just look at the charts. Euro did this ramp job into the end of the year. And I gave back like a third of my profits trading for the hedge fund in like 3 weeks trying to short that.
Right.
And it was just like this euro shortage liquidity, this euro funding shortage, whatever, this short covering into the end of the year. And I gave back like, it was more than a third of my profits for the year, and I had a boss at the time. I had my chief risk officer and CIO, and he's like, "What the hell are you doing?" It was the end of the year. I had a good year. I just got skewered. So always respect August and December markets, and that's another reason why in 18 with December, I didn't get too aggressive on the downside. I didn't buy it, but I didn't sell it because I remember the euro back then. And there was another, I should know this, the TLT, I had some call butterflies, and TLT went on this ripper on the upside, and I forgot what it was. I was short vol, and vol was exploding, and it was my first like getting stung on the options. I was like, all right, there's well into five figures that I don't need anymore. So I learned about vol expansion and being short Vega. And it's terrible. I should know the year with that TLT. You could look at the TLT. It was like just like the euro, just
vertical. Good lessons learned. We're almost out of time, but I do want to ask. I love to think about what you do outside of investing and how that helps inform what you do. So I'm a student pilot of thinking about
that's
aviation.
Awesome.
Yeah, now you have experience in competitive sports as in skiing, right?
Yeah.
Can you tell us just a little bit? I mean, is there an example of something that you learned or part of that that you think reflects well to investors, to traders at all? Yeah,
it's great. It actually ties in very well with being a pilot, because your whole flight plan needs to be laid out ahead of time.
Yes.
Like 90% of your flight is laid out ahead of time.
That's exactly right.
There's a few variables that will pop up. A ski race is the same way. So I was a Division I ski racer in upstate New York in Lake Placid, and the same thing, a flight plan with the ski race. You watch the Olympics and guys are bombing down at 50 or 80 miles an hour. What you don't see is 3 or 4 hours of course inspection ahead of time. You slide down. All teams slide down with your coach and your team, and you're looking at terrain. You're looking at, okay, there's a bank turn here. The sun's hitting that snow. It's going to have more moisture content. You got to get up over your skis. That's going to be in the, a sharp drop away, a fall away, icy. You got to get high. You got to, at those speeds, you got to have a game game plan because you can't just get in there cold because there's so much information to take in.
Yes.
Most of it needs to be built into a trade plan or ski plan ahead of time because there will be things that pop up. The course will deteriorate as guys go down, and you have to be firing on your game plan and adapt to the unknown variable.
Yes.
So I took that course inspection into skiing and applied it to trading. That's why I wound up with Elliott and Fib in Intermarket Analysis. And in my process, you should have 80% of your trade done before $1 goes into the market.
That's right.
Because there will be things that pop up.
Yes.
I mean, the worst case in skiing is you wind up in the trees. Worst case in flying.
You don't fly much more.
You don't fly much more. So a lot more work needs to go in before a trader.
Isn't that great? And with both of those similarities and with investing as well, it's the stuff you don't see necessarily. It's all the stuff that happens beforehand that allows you to make good decisions when you need to because you've done all that prep ahead of time.
Right. You got to love the process.
Yes.
You have to love the process, and that's why. You know, the process, like the pursuit of trying to figure out what's going to happen in the future. It's such an awesome intellectual game that's taxing. And that's why I do get, frustrated sometimes. And people, new traders, they're anxious and they say, "Give me the formula, give me the secret." Come on, man. There's no secret. You got to love the game, love the pursuit.
Got to spend the time, right? Todd, this was such a pleasure to sit down with you.
Thank you so much.
I feel like we could go on for hours with all these themes. So I hope we can have you back on at some point in the future.
You guys are doing. I love what you guys are doing at StockCharts. Congratulations on the new position.
Thank you so much. Appreciate it. I want to thank so much Todd Gordon, founder of Trading Analysis, sitting down with us today at the Traders Expo in Las Vegas.
Dave, thanks so much.
Cheers, Todd.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.